Good morning. This is Gary DeWaal, and this is Bridging the Week for January 4th to 8th, and today is January 11th, 2016. Last week, the Financial Industry Regulatory Authority announced its regulation and examination priorities for 2016. The big surprise was that FINRA will soon be issuing to member firms monthly report cards showing possible layering or spoofing activities. In addition, a federal appeals court in Illinois held that the bank funding a loan to the now-defunct investment management firm, Sentinel Management Group, was on inquiry notice that something was wrong with collateral it received in connection with the loan prior to the firm filing for bankruptcy. Also, Stephen A. Cohen settled his failure to supervise charges with the Securities and Exchange Commission by payment of no fine. We have a few articles to cover this week, so let's get started. The Financial Industry Regulatory Authority kicked off the new year by issuing its annual regulatory and examination priorities letter. This year, FINRA indicated that its emphasis will be on three areas: culture, conflicts of interest, and ethics, supervision, risk management and controls, and liquidity. To evaluate a firm's culture, FINRA indicated it will endeavor to determine if control functions, quote, are valued, end of quote, at the organization, whether breaches of policy and controls are tolerated, whether the organization proactively endeavors to identify potential risk and compliance issues, whether supervisors embody the firm's culture, and whether subcultures that might develop within the organization contrary to the firm's culture, for example, in branches or on trading desks, are, quote, identified and addressed, end of quote. FINRA likewise indicated it would key in on four areas to assess the effectiveness of members' supervision, risk management, and controls. These are handling of conflicts of interest, technology, including maintaining effective cybersecurity and data quality, outsourcing, and anti-money laundering. According to FINRA, quote, while many firms have improved their cybersecurity defenses, others have not, or their enhancements have been inadequate, end of quote. Additionally, FINRA said it would this year review whether firms' funding plans are adequate in light of their business models. According to FINRA, this is because, quote, failures to manage liquidity have contributed to both individual firm failure and systematic crisis, end of quote. In particular, FINRA noted it would focus on the liquidity planning and controls of high-frequency trading firms. Finally, FINRA noted it plans to issue monthly report cards to firms that focus on layering and spoofing. According to FINRA, quote, the report cards will provide information both with respect to instances where all of the potentially manipulative activity is occurring through the firm and where at least one portion of the activity is occurring through the firm while the remainder is affected outside the firm, end of quote. FINRA said it would monitor how firms use this information. What's a firm supposed to do? A federal appeals court in Illinois held that Bank of New York Mellon Corporation and Bank of New York were on quote-unquote inquiry notice that Sentinel Management Group, Inc. improperly used customer funds as collateral for a loan prior to the firm's collapse in August 2007. For those who don't remember, Sentinel was an investment management firm registered with the Commodity Futures Trading Commission as a Futures Commission merchant that claimed it specialized in short-term cash management for hedge funds, individuals, financial institutions, and other FCMs. The firm filed for bankruptcy after it unlawfully commingled $460 million of client securities into its house account and used client collateral to obtain a $321 million line of credit from Bank of New York. The court noted that at the time of the loan, at least one senior officer of the Bank of New York questioned how Sentinel, which he mistakenly believed had only $20 million of capital, when in fact it had capital less than $3 million, could have sufficient collateral to secure a $300 million loan. The court said this and other facts and evidence before the lower court demonstrated that the Bank of New York should not have reasonably accepted the collateral without further inquiry. As a result, the appeals court reversed the decision of the lower court, which had held in December 2014 that the Bank of New York's acceptance of the collateral was in good faith, and it granted the bank a priority status in Sentinel's bankruptcy proceeding. The appeals court dropped the Bank of New York status to that of a general creditor. Stephen A. Cohen, founder and owner of hedge fund advisors that use his own initials, SAC, settled an administrative complaint brought in 2013 by the Securities and Exchange Commission that he failed to supervise two portfolio managers, including Matthew Martoma, who in 2014 was convicted of insider trading and sentenced 9 years imprisonment, and Michael Steinberg. Mr. Cohen resolved the SEC's charges by agreeing not to be associated with any broker, dealer, or investment advisor in a supervisory capacity until at least December 31st, 2017. He also agreed to various undertakings, including permitting the SEC to examine his family office firms and retaining an independent consultant for his family office firms to assess their compliance with security laws. The SEC imposed no fine as part of the settlement. Previously, though, in 2013, SAC companies resolved federal criminal charges of insider trading by pleading guilty and paying a fine of $1.8 billion US. Mr. Cohen has not personally been subject to criminal charges. The SEC claimed that trades based on insider information earned Mr. Cohen's firms approximately $275 million US, quote, in illicit profits and avoided losses, end of quote. The SEC claimed, quote, Mr. Cohen ignored red flags indicating that Martoba might have access to non-public information about the clinical trial, end of quote. And finally, the CME Group is adding one new rule and amending two others to minimize the likelihood that its exchanges might be used for illicit money laundering. The changes will impose new obligation on clearing members. Currently, CME Group requires clearing members to have a written program to ensure they do not conduct business with persons named or from countries subject to economic sanctions by the U.S. government, so-called sanctioned parties. Under CME Group's new provisions, sanctioned parties are barred from accessing CME Group markets, clearing members are prohibited from accepting collateral issued by sanctioned parties, and clearing members may only carry omnibus accounts for other futures brokers who have received a notice saying they are prohibited from dealing themselves with sanctioned parties and who provide such notice themselves to their omnibus accounts. Well, that's it for this week's issue of Bridging the Week. As always, there's more information in each article and more article on the article version of Bridging the Week on the website. Check it out. Until next week, this is Gary DeWaal. Have a great week, and as always, ciao.